10-year note yields continue to trade the range after we saw the breakout high to 3.25, then the trade lower back towards 305. Now we're hovering right around 310, 311. We're kind of in that waiting game, narrow range today. Not a whole lot of exciting trade. Typically, we're used to seeing these spikes higher or lower in yield as we come in the morning, and then we kind of trade around it. We haven't seen that. We did not see that today. I think the market right now taking a deep breath. The equity market's doing well today, which gives us a chance to take a breath. And so the bond market now taking a deep breath. A lot of things coming up over the next week, and there's going to be plenty of opportunity to trade. Today was not one of those days, though. And if you look at market volatility, we saw market volatility spike last week, more so, I think, on the equity trade, less so on the bond trade. Bonds were sort of reactive to what was going on in the equity market, a risk-off trade, sort of a flight to quality bid to bonds. We saw yields come dramatically lower. Market volatility spiked higher, though, because we bucked the trend. So when you trade outside the expectations, you do typically see volatility bid. It is not something we have typically seen in the bond market because of the fact that obviously there's zero interest rate policy, Fed involvement, whatnot over the last several years. But now we're starting to see that a little bit more. When we see freak moves in the bond market, we are seeing a little bit of volatility, and we are seeing that here. So right now, bond market volatility off the highs, however, still elevated on a historical when we go back over the last few years. So right now, higher volatility. We're seeing narrow ranges. What do we have coming up ahead? First stop will be employment. Yeah, we're looking for right around up 200,000. Unemployment rates stay the same. This will continue. This will continue to feed the bond market, feed the Fed, continue to please. Jobs have not been the problem for what the Fed is doing in raising rates. Jobs have only been there to supplement what's happening because we've seen job growth for so long now. Even if we get a modest pullback in the job non-farm payroll numbers, it doesn't tend to really have an adverse effect on the market. Likewise, it may be a day or so, but the bigger picture, jobs continue to outshine other areas of the economy. And then obviously next week's a huge week when we have, not only do we have the U.S. midterm elections, which could dictate policy going forward for the next 2 years out of Congress, but we also have no FOMC, which isn't going to see a rate hike, but could see some kind of a nod about December or possibly after. Likewise, we'll look at how they tweak the rate, whether they're going to continue to look at the interest on excess reserves, how they raise that versus where they raise the Fed effective range, which now is, the Fed effective trades very near the top of that range. So how they're going to deal with that, or how they're going to talk about that, may be very key here to the short end of the Treasury curve and other contracts. But as far as we go from the bond market perspective, higher yields based on tighter monetary policy based on an expanding economy is what's been expected. However, slower growth in certain areas of the economy now threaten that. And I do think the Fed will continue to raise rates this year. Next year becomes another question as the Fed looks to raise rates north of 3% very early next year in their talking points. However, the market not quite sold yet and seeing rates south of 3% out to 2021. So right now we're seeing kind of a very mixed bag between what the Fed wants and what the market's telling it it's going to be, implying. So a lot of work still to be done there. But for right now, we're focusing on employment and next week's midterm elections, likewise with FOMC.